Beautiful people, let's make sure we smoothly continue on from what you have already covered. One thing I want you to take note before we even move forward is actually this word in between, which is called liquidity. When we calculate volume on the market, we are actually looking at how liquid the market is. Liquidity will determine if there is a strength at the support, and that strength should either help us in determining whether it's favoring a continuation to the downside if it's at the support, or it's favoring a reversal, which is where patterns are actually important on the market. Now, resistance, we all know this is actually the highest level on the market, and also volume and trend determination is actually the key that help us in finding whether the price will keep on pushing above resistance or will remain and continue reversing from the resistance to the lowest price action. Now let's move forward. We actually continue on with our lesson. Two key points, ladies and gentlemen, two key points to actually take from this episode is actually this word volume, which could be best found by understanding how to analyze accurately candlesticks, and then how to look for patterns, and then you need to also know what those patterns means, because you can't actually interpret the pattern if you don't know what it means, right? And then strength and weakness on the market is going to be actually a result of knowing how to use properly support and resistance, and also a little bit of a determination of knowing the trend, right? Now let's move forward. First, it's actually volume on the market. How can you best find volume on the market? The best way to determine the volume on the market, guys, is a proper analysis of candlestick. First and foremost, let's look at the anatomy of a candlestick. Né? A candlestick, it either has an opening price and then it has also a closing price. Now, if a candlestick has a low opening price with a high closing price, it means that candlestick is bullish in nature. It's a buy candlestick, right? So the anatomy is not only ending there. We know we have actually also these sticks in between the candlestick, because where I've shaded it in between, it's actually, this represent the body. So the distance between the opening price and the closing price is the body of the candlestick, and within the body of the candlestick, this is where we find the volume that you're looking for. Now let's move further. Candlestick stick, right? Candlestick, because it has these sticks in between, which you call the wicks. Even if you look at a candle, a real candle, it could look like this order, and then you have that thing that should burn there that has the fire on top. That's actually the wick of a candle, right? So the wicks of the candlestick will always have a low and it will always have a high. But then a bullish candlestick and a bearish candlestick, they are similar and identical for the fact that all of them, their low or the wicks will always be the lowest. It will always be the one below. And then the high of it, it will always be the one above. Irregardless of the fact that a bearish candlestick it opens up but it closes below, while a bullish one opens below and closes above. So why do you have to learn this? The point is this: in between the opening price and the closing price, this distance is actually where the volume on the market is at. Then how do you best find that volume on the market? Let's move forward and show you the best way to find that volume. Because now on this next slide, this is basically it's another candlestick. This one in particular, it has a high opening price and it has a low closing price. So the wick, it actually holds what you call, it's actually the one down here, and then you have the wick on top also having its high. So in between, if you look at the distance between here, right, and there, it's actually, it is the body of it. But the body of this candlestick is actually more narrow in comparison to the body of this other candlestick here. So if this one has a bigger body, it means there's too much volume in here. Don't mind the wicks. The wicks don't say anything about the market. They will only be relevant in natures where we draw trend lines, because mainly the wicks, their role is to play the trick. Right? They will play tricks on the market. This is where we find regions on the market which we call manipulation regions, and market manipulators are actually allowed to actually manipulate the market along regions where there will be a lot of wicks. And how do we know if the trades are going to be taking place? Mainly by determining the volume at either a level of support or a level of resistance. Guys, so on the next episode, I'm simply going to be showing you exactly how to apply this on the chart, how to look for volume at the support, and then how to look for the decrease of or increase of volume at the support or either the resistance. And I hope to see you guys there. Make sure you apply it and follow it in the order. Definitely you're gonna start making much more better progress on the market than you've ever done before. Peace.